$300 million against silver. That's the size of the bet one man just placed on the Shanghai Futures Exchange, the single largest net short position in that market's history. The man behind it is Bian Shiming, a low-profile Chinese trader who quietly accumulated nearly $3 billion from bullish gold trades over the past several years. He's not reckless, he's not guessing. He built a fortune reading metals markets, and now he's wagered 450 tons of silver, roughly 30,000 contracts, that the price is going lower, and in the short term the trade is working. Silver has dropped 16%, padding his paper gains by the day. But here's where the story fractures into something far bigger than one trader's position. At almost the exact same moment Bian Shiming was loading up his short, the Trump administration assembled representatives from 54 nations in Washington for what was officially called a critical minerals ministerial meeting. J.D. Vance and Marco Rubio sat at the head of a table representing roughly 2/3 of global GDP. And the language they used wasn't diplomatic filler. Vance stated directly that international critical minerals markets are failing, that commodity prices have been artificially suppressed by forces outside the control of individual nations, that mining operations worldwide stall and collapse because pricing is erratic, unpredictable, and structurally broken. When the Vice President of the United States stands in front of 54 countries and declares that manipulation in commodity markets must end, that price floors are coming, that supply chains need to be rebuilt from the ground up, that isn't trade policy. That's the opening salvo of an economic war, and the target, though never named explicitly, is unmistakable. This is a story about two opposing forces colliding in real time. On one side, a Chinese billionaire with $300 million riding on silver's collapse. On the other, the full weight of the American executive branch restructuring how critical minerals, and silver is a critical mineral, are priced, produced, and controlled across the planet. One of these forces will break. The question is which one, and what gets destroyed in the space between them. To understand how we arrived at this collision, you need to see the battlefield clearly. And that starts with what's actually happening to physical silver right now, not on trading screens, but in vaults, at dealer counters, and inside the delivery mechanisms that are supposed to keep this market functioning. Forget the price chart for a moment. Look at what's happening on the ground. In Australia, one of the country's major bullion dealers, City Gold, has stopped selling silver entirely. Not because demand slowed, not because they're restructuring inventory. They halted retail sales because there is a global shortage of physical silver, and they cannot source enough metal to fulfill orders. This isn't a temporary demand spike. This is a dealer telling customers, we would sell it to you, but it doesn't exist in sufficient quantity. In India, the MCX, the country's primary commodities exchange, raised margin requirements on silver by 7%. Gold margins went up only 3%. Exchanges don't hike margins because markets are calm. They hike margins because positioning has become dangerous. And the fact that silver took a hit, more than double what gold absorbed, tells you exactly where the stress is concentrated. They're not protecting individual traders. They're protecting the clearing infrastructure itself. Now look at COMEX, the exchange that's supposed to be the backbone of Western metals pricing. In just the first 4 days of February, which is not even a primary delivery month, 3,163 silver contracts were delivered. That represents 17.8 million ounces of physical silver changing hands. JP Morgan alone issued 531 delivery notices and stopped 239. These aren't paper shuffles. These are demands for real metal, and they're arriving at a pace that non-primary months aren't designed to handle. And then there's the signal that matters most, backwardation. Silver is currently trading roughly 80 cents per ounce in backwardation, meaning the spot price is higher than the front month futures price. In a normal market, the future costs more than today because of storage and carrying costs. When that relationship inverts, it means one thing. Buyers are so desperate for immediate delivery that they will pay a premium to get metal now rather than wait 3 months. Backwardation of this magnitude, arriving immediately after a historic price slam, is the market screaming that physical supply cannot meet physical demand. If you're finding this kind of analysis valuable, the stuff that doesn't show up in headlines, a like genuinely helps it reach more people. Because what comes next connects all of this to something much larger. Here's the contradiction that defines this moment. The paper price of silver just cratered 16%. Simultaneously, dealers are halting sales, exchanges are raising margins in a panic, COMEX deliveries are surging in an off month, and the spot market is in deep backwardation. The price says silver is abundant. Every physical metric says the opposite. That gap between paper narrative and physical reality isn't a glitch. It's the fault line where this entire conflict lives. Now pull the camera back and look at what's collapsing around this fault line. The cryptocurrency market hit a record $4.3 trillion market cap in early October. 4 months later, it sits at $2.3 trillion. $2 trillion in value, 46% of the entire crypto market, evaporated. Bitcoin has dropped below its 2021 all-time high. erasing years of gains in weeks. Equities are hemorrhaging alongside it. The Nasdaq shed $517 billion in a single session, down 1.34%. The S&P 500 lost $695 billion. The Russell 2000, another $47 billion. And the dollar, the supposed safe haven, is in freefall. The greenback is dumping at its fastest pace since 1980. 1 year ago, it was the strongest currency in the G10. Today, it's the second weakest. The Australian dollar has gained 8% against it. The Swedish krona is up over 10%. The New Zealand dollar has climbed more than 5%. The reasons are stacking. Escalating trade war fears driven by repeated tariff actions, growing doubts about Federal Reserve independence, as political pressure mounts for easier monetary policy, and a fiscal deficit that keeps expanding with no credible plan to reverse it. International capital is executing what traders call a sell America trade, reducing U.S. exposure across the board and moving into hard assets. And that brings us to China's long game. China's gold reserves have reached an all-time high of 74.1 million ounces. Its U.S. Treasury holdings have dropped to $682.6 billion, the lowest level in 18 years. Since the 2013 peak, Beijing has shed over $600 billion in Treasury positions, while simultaneously doubling its gold reserves. The shift from dollar-denominated paper into physical commodities isn't speculation. It's documented, measurable, and accelerating. Treasury Secretary Bissent has publicly acknowledged hearing reports that China is developing a digital asset backed by physical commodities, not the renminbi, designed specifically for international payments and reserve purposes. Every asset class is falling at the same time. Stocks, crypto, currencies, commodities on paper. That kind of synchronized destruction doesn't happen organically. It happens when leverage unwinds across an interconnected system, and when powerful actors are repositioning before the architecture changes. And that synchronized crash didn't arrive randomly. It was timed. The derivatives smash in silver and critical minerals hit just before that 54-country ministerial meeting in Washington. Think about the sequence. The Trump administration announces a coordinated gathering of nations representing 2/3 of global GDP to discuss restructuring critical mineral supply chains. And in the days leading up to it, the paper price of silver and related commodities gets hammered, hard enough to trigger margin calls, forced liquidations, and maximum pain for leveraged long positions. A Chinese billionaire establishes history's largest short position on the Shanghai Exchange. Exchanges in India raise margins aggressively. And then Vance stands at that podium and says the quiet part out loud, "These markets are broken by design, and the era of tolerating that is over." What the Trump administration announced in that room amounts to 3 simultaneous strikes. First, higher prices, not as a market outcome, but as policy. A price floor system designed to make critical mineral production economically viable for domestic producers. Second, increased production, restructuring supply chains so that mining projects don't die because an algorithm in Shanghai can crash the commodity they depend on. Third, restricting Chinese access, cutting off the mechanism by which concentrated actors can corner markets in minerals the modern economy runs on. Silver sits at the intersection of all 3. It's essential for solar panels, electronics, military applications, and monetary reserves. Here's the question embedded in everything I've just laid out, and it's the one nobody in mainstream financial coverage is asking. If the United States is actively building a price floor for critical minerals, while the largest physical shortage in modern memory intensifies, what happens to a $300 million short position built on the assumption that paper prices drive reality? Does Bian Shiming's trade get squeezed into oblivion as policy changes lock in higher structural prices? Or does the deleveraging cascade have enough momentum to push prices lower before those policy mechanisms take hold? That tension is unresolved right now, in real time. Drop your analysis in the comments. I read every single one, and some of the sharpest thinking on this channel comes from the people watching it. What we're witnessing isn't a correction in the silver market. It's the visible surface of a global restructuring in how critical minerals move from the earth to the economy. The meeting with 54 nations wasn't table setting for trade deals. It was a coordinated countermove against a system that has allowed concentrated interests to suppress commodity prices for decades. And this is where it stops being about institutions and geopolitics, because everything I've just described connects directly to the purchasing power sitting in your bank account right now. So here's the picture when you step back far enough to see the whole frame. On one side of this equation, you have a documented physical shortage, dealers halting sales, exchanges panicking over margin exposure, COMEX deliveries surging outside primary months, and backwardation confirming that spot demand is overwhelming available supply. Alongside that, the most powerful government on earth is assembling a coalition of 54 nations to restructure the pricing and production of the very metals in question, with its vice president publicly declaring that the era of artificial suppression is ending. On the other side, you have a single trader, brilliant, experienced, and historically successful, betting $300 million that the paper market still controls the narrative. Behind him, the inertia of a leveraged system where algorithms, margin calls, and forced liquidations can drive prices wherever concentrated capital wants them to go, at least temporarily. Both sides cannot be right indefinitely. The structural deficit in silver doesn't resolve at lower prices. Mines don't open when the commodity they produce trades below production cost. And a coalition of nations representing 2/3 of the world's economic output does not convene to announce price floors and supply chain independence, only to let a derivatives market overrule them. But timing is everything. Markets that are oversold can stay oversold during deleveraging events. Sentiment had reached extremes on the bullish side, leverage was stretched, and the correction, however engineered its timing may have been, reflects a genuine unwinding of crowded positioning. Every rally since the 2022 cycle low has been interrupted by exactly this kind of pullback before resuming its upward trajectory. The pattern isn't new. What's new is the scale of the policy response happening in parallel. Here's what's in your control. Understand the difference between the paper price and the physical reality beneath it. Recognize that when governments publicly declare market structures broken and convene global coalitions to fix them, the correction you're watching on a chart is not the end of a trend. It's the fulcrum point where the old system and the new one collide. Know your time horizon. If you're trading leveraged paper, risk management isn't optional. It's survival. If you're accumulating physical metal as a long-term position, the signals from vaults, dealers, and delivery reports are telling you something the spot price isn't. Remember where we started. One man, $300 million, betting against silver at the exact moment the most powerful nation on earth decided silver, his price has been a lie. The empire isn't just reshuffling the deck, it's redesigning the table. And the only variable left is whether you see the blueprint clearly enough to position yourself before the new architecture locks into place. Money always tells the truth eventually. The only question is whether you're reading the right ledger.